In this video, we're going to look at Canadian Natural Resources. This is an oil and gas company located in Calgary, Alberta, Canada. And what I do in my videos is I try to figure out the intrinsic value of a stock. This is the actual value of the company using prior financial information. And then I look at the financial ratios of the business and compare them to companies in the same industry. So let's get started with the model. This company's market cap is 27.7 billion Canadian dollars. And they're trading at $23.45. And now we need the free cash flow. This is the cash that's left over after paying your expenses. And the way you value a company is you estimate future free cash flows and discount that number back to today's dollar amount. And that's what I'm doing in this video. And we also need the net income, which is the profit and loss according to the income statement. And this is more the accounting profit and loss, because there could be some situations where you have positive earnings but yet negative cash. Also, we're going to get the revenue, which are the sales for each year. And it's good to see that their revenues have increased quite a bit every single year. And also their margins have improved significantly as well. And usually when revenues increase, your margins increase as well, because economies of scale occur and you could start doing things more efficiently. And in this case, that's exactly what this company did. It went from $17 billion in 2017 at a 14% margin to $24 billion in revenue at a 22% margin. So of course you would expect net income, which is your profit, you would expect that to increase as your revenue increases. But in their case, it increased at a greater rate. So looking at the margins helps you understand if they improved at a better rate or not on a nominal basis. Let's look at the capital structure of the business to figure out what discount rate we need to apply to the future cash flows. So the interest expense on the income statement is the interest they pay on their debt, which is $912 million. And the debt they have, we go to the balance sheet, we go to liabilities, and then the current debt is $2.4 billion. That's debt due within 12 months. And the long-term debt of $19 billion is debt due after 12 months. So they pay 4.3% interest on the debt. Interest payments are tax deductible. So let's figure out how much taxes they pay. We'll go back to the income statement. See, we can't look at 2019 because they had income of $5 billion, yet they had a refund of $460 million in taxes. Let's go back to 2018 where they had $3.5 billion of income and paid $931 million in taxes. That seems more appropriate. So the cost of debt is 3.2%. So we need the cost of equity. And to do that, we need the beta, which is how much the stock moves relative to the entire market. So this stock has a beta of 2.13. So it moves more than twice the market does. So if the market went up 1%, this stock should go up a little more than 2%. The stock has a beta over 2. It tends to be more volatile and more risky of an investment. Let's go back to the balance sheet and get their current assets, because we need to look at their ratios later on. They have $4.5 billion in current assets. That's cash, accounts receivables, and inventory. And current liabilities are debts and payables, which are due within 1 year, and that's $6.7 billion. And equity is the value of the company according to the balance sheet, which is total assets minus total liabilities, and that's $35 billion. And EBIT is earnings before interest and taxes. On the income statement, they call that operating income, $5.6 billion. So their cost of debt is 3.2%. And they have 37% debt in their capital structure. The cost of equity is 18.7%, and to figure that out, we used a capital asset pricing model. And they have 63% equity in their capital structure. So to get the weighted average cost of capital, you combine the cost of debt with the cost of equity, and you get 12.9%. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today's values. and the value for the entire company is $54 billion. We divide that by 1.2 billion shares, and we get an intrinsic calculated stock price of $46. It's trading at $23, so it's trading at a 49% discount. It's a buy, according to the model. Let's see what Simply Wall Street has. I have 46 Canadian dollars, and they're estimating the stock at 49 Canadian dollars. It's interesting how close we are. Now let's look at the ratios of the company. This will help us get more information. Really good PE of 5.1. That's price to stock over earnings per share. They have a really good price to sales also. That's of 1.1. That's price to stock over sales per share. If the stock price didn't come down so much, these ratios wouldn't look so good, but they look a lot more appealing now with the lower stock price. Price to book of under 1. That indicates if they shut down their business and use all the assets to pay off all the liabilities, the extra cash would be more than what the stock is trading at, $23 a share. So they're better off shutting its business down. Not really, but that's what the price to book indicates. Current ratio, current assets over current liabilities. They cannot cover their current liabilities. Now this is a little questionable. Sometimes it's a timing thing, where if we looked at next quarter or maybe next year's current ratio, it would be over 1. But right now it's under 1. So the ROE is 15%. That's okay. That's income over equity. So every dollar of equity, they give back to their equity holders 15 cents. Interest coverage ratio, they can easily cover their interest payments. Debt of 37%, so that's good. The best way to look at ratios is to compare them to similar companies, and that's what we're going to do. CNQ is right here, and if they have a number in green, that means they're doing better than the average in their industry. If the number's in red, they're doing worse than the average in their industry. We do see more red, but let's delve into the numbers a little bit. They have the best PE ratio. PE is a really important ratio. Some companies have negative PE ratios. Why? Because they have negative earnings. The average in the industry is 18. Their price to sales ratio is worse than the average. The average is 0.9. They're at 1.1. Shawcor, a Canadian company, has the best price to sales, price to book, and current ratio. But they're not making any money. Our company has the best ROE at 15%. Lots of companies aren't even returning anything to their equity holders. Debt, the average is 35%, we're at 37%. So all the companies take on debt, but none of the companies are too leveraged. As long as they're around 50% or less, it's manageable. So give me some feedback. Let me know what you think of this video. Do you invest in oil and gas companies? What's your preference? Thanks for watching.